Well, as we mentioned, it's going to be a pretty busy week, particularly on Wall Street, with many of those big technology companies, Meta and Microsoft and Alphabet, Amazon, Apple, all set to report their quarterly results. And we've talked so much about how these described magnificent names have played a huge role in the S&P's record run. Our next guest is somewhat cautious on big tech. Phillip Colmar is a managing partner and global strategist at MRB Partners. He joins us as part of our opening bell coverage. Nice to see you. What are your expectations? Do you think the market is going to respond well to this latest batch of earnings?
It's going to be tough. I think you've got many of the tech have low year-over-year comps. So beating comps from last year won't be challenging necessarily in the first half. In the second half, it gets progressively more challenging. But what I think concerns us is that expectations for earnings are quite elevated this year, extremely elevated. And actually, they're elevated on a multi-year run, probably the highest we've seen since the dot-com bubble. So that's a challenge. I think the key really for us is going to see whether they can produce on the revenue side. And this comes at a point when what also concerns us is business spending on technology has really slowed dramatically. It's actually ground to a halt. So that signals some damage for revenues or some concerns about revenues in the year ahead. And actually, even if you look underneath the surface of those magnificent seven, as you say, there's a real discrepancy between those, a couple of them that are generating decent revenue growth, and many of them are having pretty sluggish revenue growth. So earnings of expectations are rallying, but revenues better match it, or we got a real problem on the multi-year earnings expectations for these stocks.
Now, for the Canadian market, where we have a few tech names as well, but I think the percentage of the TSX, the weighting, if you will, that encompasses tech is less than 10%. So generally, you know, there's different ways to invest out there. In the TSX, you have less exposure to big tech. But do you think for indice performance this year, your perspective on tech is something for people broadly speaking who are investing in different markets around the world should consider?
It's pretty much a global story in tech. I mean, we do like some of the more related ones in, say, emerging Asia, because we see a semiconductor cycle coming out of there. We see some greater strength especially after those emerging Asian stocks more broadly have been faced some weakness. But our caution on tech is pretty much a broader global story. We just find better places to rotate into other cyclicals that have been laggard, better risk reward, if you will. I think the big theme of this year is that investors expected we were coming into this year in that soft landing Goldilocks scenario where we'd get, you know, decent, okay growth, not recessionary, but weak enough to bring down inflation and get deep Fed rate cuts. And I think the big theme is unwinding that. Actually, the monetary conditions easing that we've seen is actually going to result in, it already looks like it's resulting in a no landing scenario, at least for the US economy, and not as deep a Fed rate cuts. In that mix, growth is on your side for some of those laggard cyclical sectors to kind of pick up. And at the same time, bond yields, the risks are now skewed back again to the upside. So that doesn't favor your long duration sort of growth related tech sector. It favors some of those other cyclicals, maybe augmented a little bit with some of the defensives like healthcare, but it does. So I'm thinking here about banks, but I'm thinking across the border, not in Canada, but into the United States, banks in US and Europe, but also things like aerospace and defense, look appealing to us. And we recently added energy, and that does come back into Canada. So in terms of an overweight allocation, so Canada's energy might benefit there.
All right. Well, we're certainly going to be continuing to watch what's happening in the energy sector. One of the things that we talked about already this hour was that when you look at some of the historical U.S. charts, that if we enter into, in the United States, a rate-cutting cycle, the state of the economy, and you talked about maybe even a no landing as opposed to a soft landing. But, you know, if the economic backdrop is holding up relatively well as you start to cut rates, that's generally speaking a better environment for stocks. Now, I would be curious by comparison, because we just got through an interest rate decision in Canada last week where the Bank of Canada said that we have likely seen a peak in rates. How would you compare the economic picture here in Canada and this idea of a so-called soft landing in Canada versus the United States?
So I think in Canada it has a lot more challenges than the United States. The United States had a much better foundation of a healthy household sector, no excess of debt bubble in the household sector. So it had less interest rate sensitivity. And so this monetary conditions easing is giving you sort of no landing scenario. Now, Canada will benefit from stronger global growth conditions and the recent drop in bond yields and aggregate monetary expectations, because even in Canada, interest rate expectations have come down. But Canada is really struggling here on its mortgage resets. It's very painful. It doesn't have the luxury of the south of the border. And consumers are really facing that. The housing market is very soft, actually. House prices are weak, and housing activity more generally. It's those resets are soaking up discretionary incomes. So I think the Bank of Canada, really unlike the Fed, where I would argue really no Fed rate cuts are needed, but we're likely to get some because the Fed wants to do it. In Canada's case, the BOC is going to have to play a role and help to ease that mortgage resets. I've said in the past that unfortunately Canada, when you're dealing with a bubble like this, you don't get the luxury of a mild recession, so you don't want to make a mistake here. Now, there's a bit of a reprieve right now from decent growth and lower global monetary, or easier monetary conditions globally, but that's not going to be enough on its own. So I think Canada's economy is a place where you probably do want to diversify away from, and you really want to look for the BOC to provide some offsetting support.